Now, Tesla's stock has tumbled 8%, pushing its market value below $1 trillion for the first time since November.
Tesla is not just a name of a brand, it is an empire, the king of electric cars, the company that revolutionized the industry. But today, that empire is crumbling. The Chinese automaker just overtook Tesla in global EV sales, and it is not slowing down. With cheaper cars, better supply chains, and government backing, it is expanding at an insane pace. Meanwhile, Tesla is cutting prices, struggling with production, and facing tougher competition than ever. So, is this the end of Tesla's dominance? What went wrong? And can Elon Musk save Tesla before it is too late? Let's dive into it. What's happening? For the first time in history, Tesla is no longer the best-selling EV brand in the world. That title now belongs to BYD, a Chinese automaker that has outpaced Tesla in both production and sales. In the last quarter alone, BYD sold over 526,000 EVs, surpassing Tesla's 484,000. This is not just a one-time event. This shift marks the beginning of a major power change in the EV industry. Tesla's problems do not stop with BYD. Legacy automakers like Volkswagen, Hyundai, and Ford have ramped up their EV production, offering high-quality alternatives at competitive prices. Meanwhile, new players like Rivian, Lucid, and NIO are bringing fresh innovations to the market. The competition is fiercer than ever, and Tesla is struggling to keep up. So, what went wrong? How did Tesla go from industry leader to playing defense? The warning signs were there for years. Tesla's production bottlenecks, quality control issues, and inability to deliver new models on time were red flags that many ignored. Elon Musk's leadership, once seen as Tesla's greatest asset, has now become a liability as he spreads himself too thin across multiple ventures. Tesla's business model, which once gave it an unbeatable edge, is now showing serious cracks. It is no longer the only company producing long-range EVs. It is no longer the only brand with cutting-edge software. It is no longer the only automaker with a vast charging network. The Tesla advantage is fading, and unless the company makes drastic changes, it risks becoming just another automaker in an increasingly crowded market. But is this just a temporary setback, or is Tesla facing a much deeper crisis? The complacency trap. Tesla did not lose ground overnight. The company's downfall has been years in the making, driven by one of the most dangerous mistakes any business can make: complacency. For years, Tesla acted as if its position as the EV leader was untouchable. It assumed that competitors would never match its technology or brand power. That overconfidence led to critical mistakes that are now catching up with the company. One of the biggest issues was Tesla's failure to update its lineup. The Model S, Model 3, and Model Y have dominated Tesla's sales for years, yet there have been no major design changes. Customers have been waiting for new models, refreshed interiors, and better features, but Tesla has been slow to deliver. Meanwhile, competitors like BYD, Volkswagen, and Hyundai have been rolling out new EV models at a rapid pace, offering more variety, better build quality, and lower prices. Another sign of complacency was Tesla's inability to fix production delays. The company has a history of missing deadlines and over-promising on vehicle releases. The Cybertruck, Roadster, and Tesla Semi were all announced years ago, yet delays have kept them out of customers' hands. These constant delays have frustrated Tesla's most loyal customers and allowed competitors to step in and fill the gaps. Quality control has also been a major issue for Tesla. Reports of panel gaps, software glitches, and malfunctioning driver assist features have hurt the company's reputation. Customers who once praised Tesla's innovation are now complaining about reliability problems. Tesla also made the mistake of believing that brand loyalty would keep customers from leaving. But in reality, consumers are more price-sensitive than ever. Tesla's premium pricing strategy worked when it had little competition. But now, with more affordable alternatives on the market, buyers are looking elsewhere. Tesla rested on its early success, believing that its lead would last forever. But while Tesla was standing still, competitors were moving forward at full speed. And while Tesla was stagnating, its biggest nightmare was quietly taking over: the BYD takeover. Elon Musk once laughed at BYD, dismissing it as an inferior brand. That was a huge mistake. Today, BYD is the world's best-selling EV brand, and Tesla is now playing catch-up. So, how did BYD pull this off? First, BYD had a long-term strategy that Tesla completely underestimated. Instead of focusing on luxury, BYD targeted the mass market, producing EVs that were affordable and practical. While Tesla was prioritizing high-end performance, BYD was scaling up production and improving its cost efficiency. One of BYD's biggest advantages is its control over the supply chain. Unlike Tesla, which relies on third-party battery suppliers like Panasonic and KTL, BYD manufactures its own batteries. This allows BYD to keep costs low, ensuring that its vehicles remain competitively priced. Tesla, on the other hand, has struggled with rising battery costs, making its EVs more expensive than the competition. BYD also had a massive advantage in government support. The Chinese government has aggressively promoted EV adoption, offering subsidies, incentives, and policy support that helped BYD grow rapidly. Tesla, meanwhile, has faced regulatory hurdles and shifting policies in key markets like the United States and Europe. BYD is not just winning in China, it is expanding globally. The company is aggressively entering markets in Europe, South America, and Southeast Asia, where Tesla has yet to establish a strong presence. With lower prices and competitive technology, BYD is making it harder for Tesla to compete outside the United States. Tesla can no longer ignore BYD. The once dismissed automaker is now Tesla's biggest threat, and unless Tesla finds a way to regain its competitive edge, BYD could permanently take the lead. But this was not Tesla's only problem. Its own pricing war made things even worse. Tesla's pricing disaster. When Tesla saw competition heating up, it made a desperate move. It slashed prices. At first, the price cut seemed like a smart strategy to boost sales. Lowering the price of the Model 3 and Model Y made Tesla's EVs more affordable, helping the company stay competitive. But in the long run, this decision backfired spectacularly. Tesla had built its reputation as a premium EV maker, and slashing prices made the company look unstable and desperate. Customers who had paid full price just months earlier were furious when they saw prices drop by 20% or more overnight. Some buyers canceled their orders, expecting even further price reductions. Competitors matched Tesla's price cuts, effectively canceling out the advantage. BYD, Hyundai, and Volkswagen quickly adjusted their pricing, ensuring that Tesla did not regain any lost ground. Meanwhile, Tesla's profit margins took a huge hit, making it harder for the company to reinvest in new technology and production. Then it signaled weakness to investors. Tesla's stock price plummeted as Wall Street analysts questioned the company's profitability. Once seen as a high-margin automaker, Tesla was now fighting in a price war it could not win. Tesla's price slashes were a short-term fix with long-term consequences. The company now faces a difficult challenge. Raising prices again could drive customers away, but keeping them low hurts its bottom line. And as Tesla struggled with pricing, another major issue emerged. Its production system was failing at the worst possible time. The supply chain nightmare. For years, Tesla's Gigafactory model was considered revolutionary. By controlling its own battery production, Tesla aimed to eliminate reliance on third-party suppliers, cut costs, and increase efficiency. But now, what was once Tesla's biggest strength is turning into its biggest weakness. Tesla's Gigafactories were supposed to solve supply chain issues, but instead, they had become bottlenecks. Unlike competitors that diversify their production across multiple global suppliers, Tesla has placed too many eggs in one basket. As a result, when one factory faces delays, the entire production chain suffers. At the same time, global shortages of raw materials have severely impacted Tesla's ability to manufacture vehicles. Lithium, cobalt, and nickel, the key materials used in EV batteries, have become more expensive and harder to source. Competitors like BYD have secured better supply chains, leaving Tesla scrambling for materials at higher costs. Adding to the crisis, semiconductor shortages have disrupted Tesla's ability to meet delivery targets. Unlike traditional automakers, Tesla has heavily relied on advanced chips for its vehicles' self-driving capabilities and software integration. The global chip shortage has created massive delays, forcing Tesla to scale back production and deliver cars with missing features. But perhaps the biggest issue is Tesla's over-reliance on China. Tesla outsources a massive portion of its supply chain to Chinese manufacturers, including battery components and semiconductors. With increasing tensions between China and the United States, Tesla's dependence on China could soon turn into a massive liability. Tesla's strategy of vertical integration, owning its own factories and supply chains, was once an advantage, but it is now a major burden. Unlike BYD, Volkswagen, and Hyundai, which have flexible supply networks, Tesla is trapped by its own rigid production model. But even worse, Tesla's struggles exposed a critical flaw. It was no longer the most innovative automaker. The fading tech edge. Tesla's reputation as a cutting-edge tech company is fading fast. While Tesla was once light years ahead of competitors in battery efficiency and self-driving technology, the rest of the industry has caught up and, in some cases, surpassed it. Tesla's full self-driving system was supposed to be a game-changer. Elon Musk has repeatedly promised that Tesla vehicles would achieve full autonomy, eliminating the need for human drivers. But years later, FSD is still incomplete, riddled with glitches, legal issues, and safety concerns. Tesla's competitors have now developed better driver assist technologies that outperform Tesla's FSD. Companies like Waymo and Cruise have deployed fully autonomous vehicles in real-world conditions, while Tesla's system is still struggling with phantom braking, erratic lane changes, and legal scrutiny. Adding to Tesla's problems, BYD and other Chinese automakers are developing superior in-car software. Tesla's early advantage in over-the-air updates is no longer unique. Most major automakers now offer real-time software upgrades and AI-driven vehicle monitoring. The cracks in Tesla's software reliability are becoming harder to ignore. Many customers have reported glitches in their Teslas, from frozen touchscreens to delayed acceleration responses. The once reliable Tesla software is now causing frustration among buyers. Tesla's battery technology is also falling behind. While Tesla was once the leader in battery efficiency, companies like BYD and CATL have developed cheaper, longer-lasting, and more efficient batteries. The LFP batteries used by BYD offer similar range and reliability at a much lower cost. For the first time, Tesla is no longer the undisputed leader in EV technology. As other companies innovate at a rapid pace, Tesla's once game-changing features are starting to look outdated. And while Tesla was dealing with tech issues, Elon Musk was busy with something else entirely: the Elon Musk distraction. When Elon Musk purchased Twitter for $44 billion, it was one of the most controversial moves of his career. But while Musk was focused on his new social media empire, Tesla was crumbling. Tesla investors quickly lost confidence in Musk's leadership. They feared that his attention was too divided between running Twitter and managing Tesla. As a result, Tesla's stock plummeted, losing billions in market value. Musk's Twitter takeover also damaged Tesla's brand image. His political controversies, erratic decision-making, and controversial posts alienated customers and investors alike. Many consumers, who once viewed Tesla as an innovative and future-focused brand, now associated it with Musk's personal controversies. Internally, Tesla employees felt abandoned. While Tesla was struggling with supply chain issues, pricing instability, and rising competition, Musk was more focused on banning Twitter accounts and restructuring a social media company. Even Tesla's most loyal customers started reconsidering their support. The combination of rising prices, delayed updates, and Musk's unpredictable behavior made many potential buyers hesitant. While Musk has always been known for his unconventional leadership style, his obsession with Twitter has become a serious liability for Tesla. Investors, employees, and customers alike are now questioning whether Musk can still effectively lead the company. But Musk's distraction wasn't the only thing dragging Tesla down. Geopolitics is also making things worse. China's EV takeover. China has now become the center of the electric vehicle world, and Tesla is struggling to keep up. While Tesla was once the biggest name in EVs, Chinese automakers have now taken over, and they are not slowing down. China currently controls 70% of the world's battery production. This gives Chinese automakers like BYD, NIO, and XPENG a massive advantage. They can produce electric vehicles faster and cheaper than Tesla. Tesla's reliance on China for manufacturing is now a major risk. While Tesla's Shanghai Gigafactory is a key part of its production network, it also means that Tesla is vulnerable to Chinese government policies and trade disputes. If relations between China and the United States deteriorate further, Tesla could face severe production issues, restricted access to materials, or even tariffs on its Chinese-made vehicles. While Tesla is still a major player in the global EV industry, it is no longer the clear leader. Chinese automakers are outpacing Tesla in affordability, supply chain control, and market expansion. With all of these issues piling up, can Tesla still make a comeback? Can Tesla fix its broken business model? Tesla was once the gold standard of electric vehicles, the company that changed the industry and set the stage for mass EV adoption. But now the company is facing a harsh reality. its once revolutionary business model is starting to show cracks, and if it does not adapt quickly, it could lose everything. One of the biggest problems Tesla faces is its limited vehicle lineup. For years, the company relied on a handful of models: the Model 3, Model Y, Model S, and Model X, without introducing significant updates or major redesigns. While other automakers have been launching fresh EV models every year, Tesla has been slow to innovate in terms of variety. Customers who once lined up to buy the latest Tesla now find themselves waiting years for promised releases, like the Cybertruck, Roadster, and Model 2. Without new models, Tesla risks falling behind in consumer demand, while competitors continue to expand their offerings. Production issues have also been a persistent Achilles heel. Tesla's gigafactories were supposed to be the company's greatest advantage, allowing for rapid scaling and cost efficiency. But instead, these factories have become bottlenecks. Tesla's Shanghai plant has faced disruptions due to China's policies, while its Berlin and Texas factories have struggled to meet production targets. The company's reliance on a centralized production strategy has left it vulnerable to global supply chain shocks, labor shortages, and rising raw material costs. If Tesla wants to survive, it must rethink how it builds its vehicles and diversify its supply chains to prevent future slowdowns. Another major challenge Tesla must address is its supply chain vulnerabilities, especially related to battery production. To fix this, Tesla needs to build its own battery factories and secure long-term agreements with diversified suppliers to avoid future disruptions. Tesla's business model, once considered untouchable, is now a liability. Expanding its vehicle lineup, fixing production issues, and securing a stable supply chain are urgent priorities if the company wants to maintain its position in the industry. But fixing its business model will not be enough. Tesla also has to deal with a new wave of competitors that are more aggressive than ever. The rise of legacy automakers. Old rivals are back. The battle lines in the electric vehicle market have been redrawn. Once dismissed as sluggish giants struggling to keep pace with Tesla, legacy automakers are now surging forward with bold investments, innovative technology, and a newfound urgency. Ford, Volkswagen, Hyundai, and others are no longer just playing catch-up. They're setting the stage for a fierce showdown, challenging Tesla's dominance and reshaping the EV landscape. One of the biggest shifts in the industry has been the massive investment legacy automakers have made in battery technology, production facilities, and software development. Volkswagen, for example, has committed billions of dollars to EV research, creating a dedicated EV platform that allows for faster production and lower costs. The Volkswagen ID series has already gained significant traction, offering consumers more affordable and well-built alternatives to Tesla models. Ford has also emerged as a serious competitor, thanks to the success of the Mustang Mach-E and the F-150 Lightning. These vehicles prove that legacy automakers can compete in the EV space, offering strong performance and reliability while leveraging their existing manufacturing expertise. Unlike Tesla, which is still struggling to ramp up production on new models, Ford has scaled up its EV manufacturing capacity at an impressive rate. Hyundai and Kia have also stepped up, introducing models like the Hyundai Ioniq 5 and Kia EV6, which have been praised for their design, range, and affordability. These vehicles offer faster charging speeds, premium interiors, and cutting-edge technology, features that Tesla has struggled to keep up with in its aging lineup. One major advantage that legacy automakers hold over Tesla is their customer service and dealership networks. Tesla's direct-to-consumer model may have been innovative, but it has also created significant headaches for customers needing repairs or maintenance. Legacy automakers have established service centers across the country, making it easier for customers to get support. Tesla, on the other hand, has been criticized for long wait times, poor communication, and inconsistent service quality. As more buyers enter the EV market, customer experience will play a huge role in brand loyalty. And right now, Tesla is falling behind. Legacy automakers are proving that they are not just catching up, they are surpassing Tesla in key areas. While Tesla continues to battle production delays, supply chain issues, and aging models, its old rivals are launching new EVs, expanding their customer base and capitalizing on Tesla's weaknesses. And while legacy automakers are catching up, Tesla also faces threats from a new generation of startups, New EV startups. Tesla is no longer the only name driving EV innovation. Startups like Rivian, Lucid, and Fisker are shaking up the industry with bold designs, cutting-edge technology, and fresh business models. These companies are not just following Tesla's lead. They are filling gaps Tesla has overlooked and creating new niches in the market. Rivian has quickly established itself as a major player in the EV industry. Focusing on electric trucks and adventure vehicles, the Rivian R1T and R1S have been widely praised for their build quality, innovative features, and off-road capabilities, filling a gap that Tesla has ignored. Rivian is also developing a fleet of electric delivery vans for Amazon, securing a major corporate partnership that Tesla does not have. Lucid Motors, on the other hand, is challenging Tesla in the luxury EV segment. The Lucid Air is being hailed as one of the most advanced electric sedans ever built, boasting superior range, premium materials, and next-generation battery efficiency. Lucid's focus on high-end engineering and luxury design makes it a serious competitor to Tesla's Model S. Fisker, another rising startup, is taking a different approach by emphasizing sustainable materials and innovative production techniques. The Fisker Ocean, for example, features solar panels on the roof, an eco-friendly interior, and a unique subscription-based ownership model. Tesla has yet to experiment with such alternative EV business models, leaving room for companies like Fisker to disrupt the market. These startups are proving that the EV revolution is bigger than Tesla. The days of Tesla being the only game in town are over, and if it does not adapt, it could quickly lose its position in the industry. The EV race is bigger than just Tesla versus BYD. Across the world, countries and automakers are battling for control of the industry. The global EV war. The shift to electric vehicles is not just about business competition. It is a geopolitical battle. Nations across the world are fighting for dominance in the EV sector, with China, the United States, and Europe leading the charge. China has built itself into the world's largest EV market, with over 70% of the world's battery production. Companies like BYD, NIO, and XPeng are expanding aggressively, challenging Western automakers on a global scale. The Chinese government has invested billions into EV development, ensuring its manufacturers stay ahead. Meanwhile, Europe is moving quickly toward full electrification. The European Union has introduced strict emissions regulations and EV incentives to push automakers away from gasoline-powered cars. Legacy brands like Volkswagen, BMW, and Mercedes-Benz are investing heavily in EVs, and the continent is seeing a surge in charging infrastructure. The United States, however, is in a strange position. While Tesla remains the country's largest EV producer, American automakers like Ford and General Motors are struggling to keep up. At the same time, governments around the world are phasing out gasoline-powered cars. Several European countries have announced bans on new gas car sales, starting between 2030 and 2040, forcing automakers to shift to electric. California, one of the largest car markets in the world, is set to ban new gasoline car sales by the year 2035. The auto industry is undergoing a once-in-a-century transformation. The shift to EVs is not just about which company wins, it is about which country will control the future of transportation. But in a race this massive, there will be both winners and losers. Who comes out on top? With so much change happening in the EV industry, who will emerge victorious? And who will struggle to survive? One clear winner is BYD. The company has built a cost-efficient, high-volume EV empire that is expanding across the world. It is outselling Tesla and proving that affordable electric cars can dominate the market. Tesla, on the other hand, is at a crossroads. It is still a powerful brand with strong technology, but its leadership is slipping. Elon Musk's focus on Twitter, inconsistent pricing strategies, and production issues have hurt the company's reputation. Tesla still has a chance to turn things around, but the competition is tougher than ever. Legacy automakers like Volkswagen, Ford, and Hyundai are also big winners. These companies were slow to enter the EV race, but now they are catching up fast. With huge investments in battery technology and new EV models, these traditional brands are giving Tesla a serious fight. The biggest winners, consumers. For years, Tesla was the only real option for electric cars. Now, buyers have more choices than ever. Prices are dropping, charging networks are expanding, and EV technology is improving at lightning speed. But not everyone will win. Companies that fail to adapt, like some struggling startups and slow-moving legacy automakers, will be left behind. Brands that delay EV adoption could see their market share collapse as the world moves toward an electric future. And that brings us to the final, most important question. What happens next for Tesla? The next 5 years will determine whether Tesla regains its dominance or continues to slide. The company must launch new vehicles, fix its supply chain, and regain consumer trust. Tesla's fate is still unclear. It could still revolutionize the industry again, or it could become just another automaker fighting for relevance. What do you think? Will Tesla make a comeback, or is BYD the new king of EVs? Drop your thoughts in the comments below.